In today's episode of the Brisbane Property Podcast, we are joined by Victoria Mercer, an associate from Business Depot in the field of wealth advisory. Today, we are exploring what you need to know to invest within your self-managed superannuation fund here in Queensland. We hope you enjoy this episode.
Welcome to the Brisbane Property Podcast with your hosts, Melinda and Scott Jennison.
Hi, everyone, and welcome back to another episode of the Brisbane Property Podcast with Scott and Melinda. It's always good when we have a guest on, and today we've got a special guest. We've got Victoria Mercer from Business Depot, the wealth advisory at Business Depot, and we're going to be covering a very interesting topic and a lot of people out there, which is self-managed superannuation.
Yes, welcome to the Brisbane Property Podcast, Victoria. It's great to have you on the show.
Thank you for having me.
You're very welcome. Now, Victoria, I know you and I met through a mutual connection, one of the conveyancers or solicitors that work at Business Depot. We met for coffee and we got into an intriguing conversation about purchasing property within self-managed superannuation funds. Now, just to give people some background, Victoria is an estate planning solicitor. Another name for an estate planning solicitor is a transfer of wealth specialist. So this is a specialized area of law involved in succession planning. She combines her expertise in taxation, estates, and superannuation. It's a very complex area of law, to be honest, and a very specialized area. And her role is essential in helping clients to effectively plan for the transfer of wealth, ensuring a seamless transition whilst optimizing tax efficiency and preserving the legacies of clients. Wow, it's quite a mouthful and it's quite a specialized area. What sort of got you into this area?
I was pretty lucky. I did succession law in my last kind of few semesters at university, and I really loved it, learning all the disputes that go on in families in transferring wealth. My first job out of uni was in this area in estate planning, and that grew into other areas like self-managed superannuation, because the majority of our clients have a self-managed super fund or one other structure. So I was trying to describe to my partner, who's funnily enough a family lawyer, and he's like, Victoria, I actually don't know what you do in a day, because we call ourselves estate planning lawyers, but it's much broader than that. So I say we are transfer of wealth specialists. We assist clients in transferring wealth across all entity types, which is individually, companies, trusts, self-managed superannuation funds. And what we specialize in is more complex structures where you need that specialized superannuation advice, but also tax advice.
Makes sense. And I know when you and I first met, we got into a great conversation about the complexities associated with purchasing property within self-managed superannuation funds. For those people that have not dipped their fingers into this space, we're starting to see, for whatever reason, an uptick in the inquiry that we're receiving here at Streamline Property Buyers for those buyers that are looking to purchase within their self-managed superannuation fund. So recently, some of the things that have changed within the industry is that obviously there's been a few more lenders move back into this space that was sort of shut down quite a lot in recent years. So a few more lenders are now servicing this area again in terms of lending to those bare trust entities, which we're going to get to. But I think also from the inquiry that we fielded, a lot of people are maxed out in terms of what they can afford to purchase through their own names or through other entities. So they're looking for what they can do within super if they're wanting to continue to build out an investment portfolio. So perhaps anecdotally speaking, that's one of the reasons why we're seeing more interest in this area. Would you agree that that's part of the, I guess the environment that we're in as to why we're seeing this?
Yes, I'd say that's perhaps one of the reasons. More and more young people are getting interested in their superannuation, which is a really, really good thing, because it's not just your 10.5% every paycheck. It's something a bit more substantial and important than that. There are some lenders that have come back into this space, Liberty and First Mac, and there's a couple of others, smaller lenders, which is really good to see, because the big lenders, the big four banks, have offloaded just about all of their LRBAs now. So I've had clients who've been pushed out of banks and be like, well, even though we're charging a decent interest rate to your super fund, which was about close to 9%, we don't want it. We just want out of this. So it's great to see some lenders actually moving back into the space, because we had a lull where lenders weren't in this space, and the only borrowing arrangements we were seeing through super were private arrangements where people were lending to their own super funds.
It's interesting, the self-managed side of things. I'm probably a bit more old school. I remember our accountant used to always say, I should be paying superannuation and putting money into super. And I always went back to him and said, I don't want super. I actually don't want it. I want to buy property because I believe in property, and that's the way we've always been. When the self-managed super side of thing for us, when we said, hey, let's buy some property through self-managed super, that changed the way I thought, because I thought, okay, I will put money into super now because I can actually invest it into that side of things as well. Do you help with people up front getting organised? Because we always talk about you want to make things right at the beginning. You don't want to have to go back and correct things. So is that the sort of thing you help with initially, Victoria, when you start to talk to people about trying to get the setup right?
Yeah. So where we're involved, I'm a lawyer, so I can help with the legal documentation, the legal aspects, and the structuring. I'm not an accountant and I'm not a financial planner. So if anyone comes to me saying, "Oh, is this a good deal?" I'm really the wrong person to talk to about it. Or if they want accounting advice, I'm not the right person. Getting people into the right structure is something we certainly assist with. So just in terms of the general steps, the first thing anybody has to decide when you're setting up a self-managed super fund is who are going to be the members, who are going to be the trustees. Is this the most common arrangement we see is husband and wife, or de facto partners, or same-sex partners, whatever. But it's usually spouses get into these arrangements. And the next question is, well, what trustee structure do we put you in, individual or corporate trustees? I'm a lawyer. I'm always going to tell you to go and put in a corporate trustee structure, not because it's more expensive, but because it's better for you in the long run. And then I can help you draft the trust deed, which is the third step. And every SMSF lawyer, and we're very, very fortunate here in Brisbane because we have several. Really good lawyers in Brisbane CBD. We all have our own trust deeds and they're all good. So you can go seek out anyone, go get your trust deed. But then after that, it's really back to the trustees to go and complete setup. So after that, you've got to register the fund and elect to become regulated. You've got to apply for an ABN tax file number. You've got to set up a bank account. You've got to apply for electronic services address. Do you rollover? All of that's done by the trustees, and preferably an SMSF administrator, because I like trustees who have a team behind them to make sure that they do the right thing and they get set up in the right times. So I can certainly help with the documentation and the structure side, but in terms of opening bank accounts, I don't get involved in that.
Yep.
And what about timeframes? Because obviously it's not as easy to get all of those structures set up quickly, because it is within super. Can you help our listeners understand what timeframes are involved in that setup process?
2 to 3 months, I think, realistically. If anyone's interested, the ATO, I know this is crazy because it's the ATO. The ATO have done something really good. They've got a really great setup guide that you can download for free. If you just go to Google and go Google ATO SMSF setup guide, they've got a really good comprehensive guide for how all the steps involved in setting up an SMSF. And once you read that, you'll realize it's not a quick process. We have clients that come to us and think, oh, can I just sign the deed and it's set up right? And it's like, no, you got to go set up your bank account. Anyone who's dealing with a bank at the moment will know it's not an overnight process when you're setting up a trust or SMSF of any form. You have to give them time. It takes time to do your rollover and get money into the fund so you can then go acquire a property. So it's not an overnight thing. It's not ideal to contact me 48 hours before going to auction and being like, oh, I need a super fund, dude. I'm like, oh, that's nice.
That is not going to happen.
It's not going to happen. I can give you the deed, but there's a lot to happen before that.
Yeah.
And not just the entity, it's also the finance. Let's talk a little bit more specifically about buying property within a self-managed superannuation fund, because there's a few different options for people, as I understand it. Can you help our listeners understand what are those options?
Okay, so the two broad options. So one is direct investment through your self-managed super fund. The other is indirect investment. So direct investment is outright purchase, which is you have a fund that has enough money to go and buy 100% of the property. Mm-hmm. The second option is tenants in common, which is the super fund with another party goes and buys a property in proportion. So that's second option. Third option is a borrowing arrangement or a limited recourse borrowing arrangements where the fund buys it, but it uses money from a lender to go and acquire the property. So that's all the direct acquisitions. In terms of indirect, I'm not talking about things like managed investment schemes or managed portfolios like Charter Hall, where you go and invest in their funds and they go buy property. These are private arrangements. So it's a bit unusual. They're called, or in the industry, we call them unrelated trusts or ungeared trusts, just to simplify them. It's you as the SMSF and other parties, related or unrelated, depending which structure you're using, get together and invest in a unit trust, and then that unit trust goes and buys the property. So it's a structure that parties use to come together to acquire property, and they're very regulated.
So from what you've just described as the various options available to those that have a self-managed super fund set up, if they are exploring property as an option, the most likely scenario that people would be looking at is potentially that limited recourse borrowing arrangement where they have a certain amount of money within the fund that's been contributed over many years through their contributions, and they're going to use that towards the deposit and purchase cost, but they're going to actually go to a bank and borrow the balance. But it's not as simple as just going to a bank and borrowing the balance like you would if you were purchasing in your own name. There's a lot more involved. Can you help our listeners understand a little bit more about what is actually involved in that arrangement?
Okay, so the starting position with self-managed super funds, and I'm only going to talk about self-managed super funds, not large industry funds. So I'm just going to stick to my area. So with self-managed super funds, the starting position is super funds can't borrow, full stop. But a long time ago, the government came out and said, okay, I think we are going to let you borrow, but it has to be within a limited arrangement. And what the government is concerned about is when you go and buy a property in your own name, the bank takes a mortgage over the property, but potentially a charge against all your other assets. And that terrifies the government because, well, from one purchase of a property, you put at risk your entire retirement savings and all the assets in the fund. So they said, look, we don't like that. So we're going to let you borrow, but what you have to do is the super fund has to appoint an agent, which is wholly owned by the fund, an agent, and the lender can only take security over the property held by that agent. So what it does is it separates the property out from the fund. And it's called limited recourse borrowing because the recourse of the lender is limited to that asset, limited recourse borrowing.
Yeah, and that makes perfect sense in terms of if you're purchasing to buy a residential property, and for whatever reason you default on those repayments, the bank can actually only retain that single residential property regardless of what other funds or what other assets exist within that super fund. Is that right?
Yep. So even there's other rules in the superannuation laws that said unless it's part of this arrangement, the bank can't take a charge over the other assets and the trustees have to make sure. So all the recourse of the bank is limited to that one asset held by the agent.
So can you help then with our listeners to understand, I know you've touched briefly on it, but when we talk about things like bare trusts and that type of setup, so there's a whole setup behind everything really to make sure this is all done right. But then that can't be done before or sort of can be done before. I'll let you explain it probably better than what I will.
The timing of when you need to set it up.
The timing of that bare trust, when it has to be set up.
Okay, so the agent that I'm referring to, it's usually done by a bare trust arrangement or it can be done by agency, custodian, bare trust, holding trust. We call ours security trust. It's all the same thing. So in Queensland, that bare trust has to be established before you go and purchase the property. So the reason you have to do that is if the trustee of that bare trust goes and acquires the property and then later declares the trust or says, I'm actually holding it as an agent for the super fund, you actually have two dutiable events. First, on the acquisition, you have to pay transfer duty on the full amount. And then when you declare it that you're actually holding it on trust, that's a second transfer duty event. So it's double duty, which is not good. So when you go and purchase a property, you have to make sure your bare trust is set up first. But The problem is the way most bare trustees are drafted, you have to know what
Yes.
property you're going to buy.
Yep.
So you can't sign the contract without the bare trust, and you can't do the bare trust without the contract. So ideally, in a perfect world, what you would have is a really good relationship with a deed provider, person who provides these trust deeds. Leave the address blank, and then when you know you've found a property you want, fill in the blank, sign that, and then 2 seconds later sign the contract.
Yep.
Yes.
It can be signed on the same day. That's ideal. And then if you lose that contract, you can reuse that deed rather than paying for a new fresh deed. Ours is slightly different, which is we don't list an address in our bare trust deed for this reason. And our preference is you set up the bare trust deed, you can go and apply for contracts. If you do get one, we can come back later and fill in the address and do other things. So depends on your deed provider. Have a good relationship with them. Just make sure it's signed before.
And this is Queensland specific, because I know a lot of our self-managed super fund buyers at Streamline Property Buyers, they're not necessarily from Queensland, or even if they own other property within their super fund, it's sometimes a surprise to them at just how everything must be perfectly aligned when you find that property, to ensure that their trust deed is signed on the same day as the contract is entered into, because there's some complexity around the paperwork associated with that. So it differs in different states.
And it's exactly the opposite in New South Wales, that you sign the bare trust deed after.
There you go. So no wonder consumers or property buyers are confused if they're building a portfolio across multiple states. Obviously, real estate is state-based legislation, but in terms of self-managed superannuation fund trust deeds, that's clearly state-based as well.
Yeah.
Interesting.
Well, I think you explained it better than I did.
That's all right.
Now, there's some compliance associated with buying property within superannuation as well. For example, if I owned a property and I wanted to transfer that into my super fund, is that possible? Can I do that?
So if you own a property, can you transfer it to your self-managed super fund? That's an interesting question. So I might... because the compliance framework for self-managed super funds is really big.
Mm-hmm.
So I thought maybe if I look at LRBAs first and then look at the broader spectrum. So if we are doing limited recourse borrowing arrangements, which is your question, which is can we buy the property? And that's a good question. So there is a prohibition in the superannuation laws that says you cannot acquire property from related parties. That's the starting position.
Mm-hmm.
And then there's a carve out for that unless it's business real property.
Right.
Now, business real property is a concept inside superannuation laws that's a niche, and it's probably why most property inside self-managed super funds is business real property. So business real property is property wholly exclusively used on one or more businesses.
Mm-hmm.
Sorry, nice long definition there. So if the property you're looking to acquire, so if you've got I'll use this example. If you have a residential property in your own name and it's doing killer with the rent right now, and you go, oh, this would be so great inside my self-managed super fund, because then all the rent would be taxed at 15% rather than my current marginal rate, and I'm getting smashed at my current marginal rate. Your super fund could not borrow it from you because of the prohibition from acquiring assets from related parties. If, on the other hand, it was business real property, so I'll use these premises here because it's real property and it's used entirely 100% in your business, so it's business real property, you could acquire it from yourself into your super fund. And this is the arrangement we see with most families. So they have premises like these. They acquire it through their self-managed super fund through a limited recourse borrowing arrangement. So they borrow from... I'm going to pick on Liberty. So they borrow from Liberty to buy the property. Then they put in place an arm's length lease between their super fund and the business. So the business leases it from their own self-managed super fund at an arm's length rental. And I emphasize that to the moon and back. Everything's arm's length. And then so the result of that is the business gets the deduction for the rent. And also, gets the deduction for the rent. The super fund gets all the rent and pays 15% tax, and you are the landlord. So you have control over your own destiny.
Yep.
You make the repayments, most of the time get the deduction on the interest. So it's probably the most common arrangement. So if it's business real property, you can certainly acquire it from yourself.
So arm's length, I'm assuming that means on commercial arrangements and no, under the table sort of arrangements or deals.
Yeah, there's this concept inside superannuation law about dealing with parties at arm's length.
Yeah.
And bad stuff happens on either side of arm's length. So if the super fund is entered into any form of arrangement where it's getting a good deal than it otherwise would, then you have problems with non-arm's length income. And then if you go the other way and you're using your super fund to benefit someone else, you also fall foul of the rules. Either way you go, there's going to be problems.
Yeah.
And what the superannuation laws are targeted at is they're trying to legislate what a prudent trustee would do.
Yeah, that makes perfect sense. Yeah.
So when you look at it through that frame, all the rules make a lot more sense. And what we're talking about is the number one biggest issue in super at the moment, which is non-arm's length income.
Yep.
So you guys, I know we've spoken about it, but I might elaborate for the audience what that actually means, because it is going to be your number one issue, or really up there if you are going to go and buy property inside super, which means that if the super fund derives income from an arrangement where they're dealing with another party not at arm's length, so it's not commercial market, and the super fund ends up getting more income than it would if they were dealing with each other at arm's length, all of that income is taxed at 45%. And then that's where you grip the table and go, oh my
Huge
goodness,
penalties.
you go from 15% or 10% on capital gains to 45%. It is crazy. So one example, going back to our commercial property in the LRBA example, if the rent you're paying to yourself, so if you bought this property inside your super fund, the business here, Streamline, was leasing it from the fund, but you were paying above market rent, because it's great because you get to put more money into your super fund without the contributions caps. If you're paying above market rent, all of that income plus the capital gain at the end will be taxed at 45%.
And that's a huge risk for people that, wanting to bend the rules effectively.
Yep.
From what you've talked about, there's so much red tape, let's just say, that it's more difficult to set up the super fund right from the outset if it's a self-managed super fund.
Yep.
It's more difficult to set up lending arrangements because it's a limited recourse borrowing arrangement.
Yep.
Obviously, you need to ensure that everything is at arm's length, but surely there's some benefits. Why are people then continuing to look at superannuation funds or self-managed superannuation funds to invest in property? Is it tax benefits?
Yeah. It's mostly about tax. It's some about estate planning. So to give people a feel for it, super funds pay tax, at least in accumulation phase, which is the phase that you're in before you hit retirement and can take money out, at 15%. And name another entity that you can get a 15% tax rate. And then when you move into retirement phase, which is, we can start taking money out now and we can commence pensions, depending on what your balance is, most part is tax-free. So that's why people do it. They buy property in their fund, they hold onto it for a long time, and then they sell the property while they're in pension phase and pay little to no tax.
Which is a huge advantage, because obviously with any other entity structure or even purchasing in your own name, there is some form of tax payable as you accumulate, or during accumulation phase, you're going to pay income tax on the proceeds over and above expenses, and that could be at your marginal tax rate or at a company tax rate. Alternatively, if you're looking to sell a property, you're going to be subject to capital gains tax or company tax, depending on the entity once again. So you've heard it today within superannuation. If you sell in pension phase, that is the phase when you actually move into relying on that income for your retirement. The majority of the proceeds will be tax-free. So there's huge benefits to exploring this entity type as an option for buyers that may be tapped out elsewhere. And certainly there's lots of rules and regulations that people need to comply with as well.
Yeah, and that was the trade-off that the government gave. which is we're going to make you lock up your money for a really, really long time. We're going to give you an incentive to do that.
Which is interesting because from a property investment perspective, the majority of property investors are investing for their retirement. Yep. So when we're considering an investment plan for an individual, regardless of age, we're always talking about retirement income. And, you know, if there's a way to build an investment portfolio in a tax effective way, it's something that people could explore depending on their personal circumstances. So it's really good insights that you've provided.
Victoria, I know you talked a little bit about commercial properties. And I mean, when you're talking about our office here, for example, as you use it as an example, we also get a lot of investors that are looking for residential property. And then we have people that talk about developments, renovations, all those types of things. Is that something in self-managed super to consider or can't be done, just to help our listeners understand at what sort of level they look at that sort of thing or cap out and can't do it?
Okay, so with residential property, you're okay if you buy the residential property from a completely unrelated third party. Mm-hmm. And if you do building works on it, you employ a completely separate third party to do any development, and then you lease the property to a third party tenant who is completely unrelated to you in every way. You do that, you're fine. Do anything different from that, you're not fine.
That sounds like an arm's length.
Yeah. Yeah, absolutely. So you can't acquire residential property from a related party, which is Section 66. If you do any renovations yourself, and it's a super fine line, and go get advice, because what people do is go, I'm a builder. I'm just going to spend my weekends ripping out this room and redoing the bathroom and redoing this, that, and the other, and I'm not going to charge my super fund from it. Be so careful, because you contain all the income from that point onwards as non-arm's length income, just because you try to save yourself some money on building costs. So be very careful. And then if you go and lease the property to any party except a third party. So if you guys buy a residential property in your super fund and lease it to your kids, well, that's an in-house asset. So loan to investment in related party or related trust, Section 71. And if you do that, then you have to get rid of the lease or potentially the property. So that's another problem. So if you do, as I said, everything's third party and arm's length, you're fine. If you're anything different from that, you run into problems.
So from what you've said, the importance is compliance within superannuation. It's dotting your I's, crossing your T's, making sure that the choices that you're making are all arm's length transaction or relationship choices, and keeping very good documentation around what you're doing. Just touching on any property improvements as well, that any improvement works need to be paid for out of the fund itself, not out of the limited recourse borrowing facility as well.
Right. You can't use the borrowed money from the LRBA to go and make improvements. So you have to be very careful. You have to use super fund monies. The ATO is on the warpath at the moment. There was an argument. It's a real problem with farmers, actually, because just over the weekend, they go and put a fence up on their land, which is owned in the super funds. And they go put a fence up and they don't charge the fund for it. And what we used to be able to say is that the fencing is a contribution. Because a contribution is actually anything which increases the value of the fund. So you could note it down as a contribution, but the ATO is on the warpath now and says that, no, that's not a contribution, that's a non-arm's length expense. And because the fund hasn't paid for it, you've derived non-arm's length income. And there we go. We're back in the 45 cents in the dollar argument again. So it is really important to make sure if you are doing improvements, you are getting advice. And ideally, everyone has a team of advisors, which means they have an SMSF administrator to do the accounts, but they also know a lot about, they're almost always specialists, which is what you want. And then you have an accountant that specializes in super, which is useful because your accountant is usually your first point of call. And then your accountant can go, I think there's a problem here, and calls a lawyer who's also an SMSF specialist. So, and we're very lucky here in Brisbane, we have a lot that you can call.
We've talked a lot about holding property within super, what you can do, what you can't do, but exiting property from within a self-managed superannuation fund is another whole area that people need to be aware of. It's not the same, different rules apply yet again. Can you sort of help us understand some of the things people need to be aware of if they're looking to sell a property potentially within super, or even pass it on to others beyond their, with their estate?
Yeah. So when you sell property within super, it will largely depend on what phase you're in, rather an accumulation phase, which is the phase where you can't touch it, or you can touch it and you've commenced pensions. In terms of death benefit planning, that is very, very important, because when you get into one of these arrangements, you have to think, how am I going to get out of it? And it's the 3 Ds. It's death, disablement, and divorce. Those three things will really screw up whatever plan that you have. So what I would love to sell with every SMSF establishment that I do is a binding death benefit nomination and an enduring power of attorney. So binding death benefit nomination, well, people are very surprised that your will doesn't govern your super. And the reason is they're separate entities. So your will only covers assets that you own personally, and then your superannuation is a separate trust. It's a separate entity entirely. So you should do a binding death benefit nomination, nominating where your super has to go. The summary is it's very limited who you can pay it to, which is your spouse, your kids, other dependents, or your estate. In most cases, and I'm just going to pick on you two because you're here and you won't mind me, and I think you're both first marriage and you've got children, so you're probably the most typical situation that I see. If something happens to one of you, I assume that with your self-managed super fund, you want the survivor to continue running the fund just on their own. You don't want to invite anyone else in. That's really important, because that goes back to one of our first discussions, which is who should be trustee, which is you should have a corporate trustee then, because if you had individual trustees and one of you weren't here, I'm going to kill you off, Scott. Sorry.
Yeah.
Men always do.
He's older, so that's okay.
If Melinda's here, how do you feel about going and finding someone else in the world to be a co-trustee with you, know all your financial circumstances, to be joined with you at the hip about all your decisions? Well, you probably wouldn't like that very much. So you need a corporate trustee. So if one of you aren't here, the survivor can just keep things going. So that's the first thing. And then that's where the enduring power of attorney comes in quite a lot, because if you lose capacity, so Scott, I'm sorry, I'm going to hit you. You're in a coma, you've been hit by a car. So if that happens again, you can't be a trustee anymore because you don't have capacity. So you want Melinda to be able to operate the fund. If she's your power of attorney, she can do that, and you can do that without bringing anyone else in or doing anything or having to go to QCAT. Because if you don't have a enduring power of attorney, you'll have to go apply to a QCAT, which is long and expensive. So whatever the money that's going to cost you to do enduring power of attorney, it's way cheaper than that. So that's first thing. Have an enduring power of attorney that appoints the right people to be trustees if you can't act. And then if when Scott dies and you've got property inside your fund, if you pay it to your spouse, so what I'm going to assume you've got 500,000 each in super and you've got a property in there that's worth 800,000. When Scott dies, his $500,000 in your member benefit, it actually has to come out of the fund. A death benefit has to be paid, but there's a carve out for spouses that if you pay a pension to Melinda, you can keep the capital in the fund, the 500,000, and pay pension to you. And then when you're no longer here, we've got to think about what happens with your benefit, because you'll have the combined equity in the fund. And when that happens, it'll have to come out of the fund properly, because unless you want to pay child pensions, but I won't go into that. The property will have to come out of the fund and you'll have to pay transfer duty unless you sell it. So that's a long way of saying that between spouses, 9 times out of 10, you'll have a nomination paying the super to each other, because it allows you to keep the property in the fund. It keeps your spouse solely in control, assuming you have corporate trustees. They take a pension and you don't have to sell the property. You can keep the plan going if something happens to you before you decide to sell the property. For all that to happen, though, you need a nomination,
Mm.
which makes that direction about how it's going to happen. And it does have to fit into your whole plan. And the reason I say 9 times out of 10, that's what's going to happen is the 1 out of 10 is blended families,
Mhm.
where if this was your second marriage and Scott, you have kids from a previous relationship, Melinda, you have your kids from a previous relationship, you might want your super to go to your kids from your first marriage because your spouse has enough super. And then the other one is my spouse already has too much super, they don't need my super, which I've also seen that when one spouse dies, they want their super to go directly to the kids, which is fine.
Mm.
So subject to those different scenarios, most times it's to the spouse because you can preserve the money inside super and just pay a pension. And just to clarify that point, if you do have super inside a property inside super and you have to pay death benefit because the money can't go to a spouse because when you're both not here, the money has to come out. If you sell the property inside super, the incoming purchaser will pay the transfer duty. If you want to transfer it to, say, the estate and keep the property, and we have one client who owns a set of shops inside of his super fund. So he put it in the super fund about 20 years ago when you had huge contribution caps and you could do that. He's not going to sell the property.
Mm.
So he'll probably have to pay 300 grand in transfer duty to get it out.
Yeah.
So it's something to keep in mind that when you go into these things, just keep in mind, what are we going to do with the property if one of you isn't here? And what's the plan? And a not binding death benefit nomination and an EPOA will sort you out with most issues.
So we've done over 200 episodes of the Brisbane Property Podcast. That's the first time I've been hit by a car and died. In all
There's
of the
always a
episodes.
I think, though, what you've clearly explained, Victoria, for all of our listeners is that buying property within a self-managed super fund is complex. There's a lot of rules and there's a lot of regulations that people need to be aware of, and they should not actually, consider this as an option without professional advice. What would be your closing comments in that regard?
It's tricky but doable.
It's tricky but doable.
Look, I've written down a couple of things, and one of the things I actually did write down was obviously team and being organised. If people need help, how do they get in touch with you, Victoria?
You can go to our website, Business Depot, and all my contact details are there. Give me a call or flick me an email.
Yeah, I think if anyone's considering anything with the likes of self-managed super, that side of things, and also, that estate planning side of things, I think it's highly recommended and a really, really good idea to plan that because you never know what is around the corner, as I've found out today.
I mean, you don't need anything. If you know when you're going to die and when you're going to lose capacity, you could probably leave your binding death benefit nomination and EPOA and your will to the very end. If you know when those things are going to happen to you, sure.
Yep. Yeah, no, be organised. Melinda, have you got any takeaways?
Look, I think the biggest takeaway that I've heard today is that if you are not doing the right thing within super and if you are not transacting with arm's length agreements in place, your tax obligation could change from 15% right up to 45% if you are non-compliant. The second thing that I'd like to just remind people was a great tip that Victoria shared, and that is if you Google ATO SMSF setup guide or self-managed superannuation fund setup guide, you'll get a fabulous summary of what is actually involved, and that might be enough just to give you a baseline understanding of what you need to do. But finally, I'd say reach out to a professional like Victoria, who will be able to ensure that your interests are protected and you understand both pros and cons before actually entering into this type of arrangement.
Terrific. Thank you, guys.
I think it's a great way to invest as well, that self-managed super. But as we've said, get a team, get the advice, get set up and be prepared because there is a time frame to be prepared to go and purchase property.
And know what you're getting into and where that guided as well for the ATO. The ATO have done unusually well at creating material, educating trustees about their obligations. If you go onto their website, it's probably some of their best material. They have videos and plenty to read about what the obligations of trustees are. So it's totally free.
Yep.
So if you're interested in it, please go have a read of that first.
Excellent. Well, thank you very much for coming in for a chat. Really appreciate it. I'm sure our listeners got a lot out of that. If you're unsure, reach out to the team at Streamline Property Buyers. We can definitely put you in contact with the right people, especially with Victoria. And yeah, I think it's a great way to invest into property as well, to set up for future as well. Look, as usual, I will let Melinda wrap it up. Thanks again, Victoria, for coming in to join us. And I'll let Melinda wrap it up. From me, take care and bye for now.
Victoria, thank you so much for your time. We really appreciate you sharing all this knowledge with our listeners today.
No worries. Thank you for having me.
You're very welcome. To all of those who have stayed right to the end, thank you once again for joining us on the Brisbane Property Podcast. As always, if you have enjoyed this week's content, please share with someone that you know that may be considering an investment within their self-managed super fund. There's a lot of gold nuggets that we've provided that will help to steer you or any of your colleagues in the right direction. As always, we'd love for you to leave us a review. Please share this episode with others. We look forward to speaking with you again next week. Bye for now.